The true threat to the future of the American economy isn't an AI bubble, the rise of China, or the political theater in the Oval Office. The real danger lies within a topic so boring that you've likely never heard of it unless you've ventured deep into the financial rabbit hole. If you've been wondering why mortgage rates stay stubbornly high or why markets suddenly panic for no apparent reason, the answer isn't in Washington, it's in Tokyo. For 30 years, Japan has been the invisible duct tape holding the global financial structure together. But that tape is finally starting to peel.
The story begins in 1992 when Japan's massive asset bubble burst, sending the country into the lost decades, a period marked by zero growth, stagnant wages, and no inflation. To jumpstart the economy, the Bank of Japan, the BOJ, didn't just cut rates to zero, they took them into negative territory. They even implemented yield curve control, essentially supergluing long-term interest rates to the floor regardless of market forces. With no way to earn a return at home, Japanese investors were forced to look abroad, turning Japan into the world's largest net creditor.
Effectively, Japan became the world's ATM. Investors realized they could borrow money in yen at nearly 0% interest, convert it to dollars, and buy U.S. treasuries yielding 4%, or put that money into tech stocks and real estate. This is the yen carry trade. At its peak, this flow of liquidity was estimated to be in the trillions, acting like the Wi-Fi that powered global markets. However, this entire system relied on one dangerous assumption, that Japanese interest rates would stay at zero forever. In 2024, that assumption was shattered. When the Bank of Japan raised interest rates for the first time in 17 years, it sent a shockwave through the system. As Japanese yields rise, borrowing in yen becomes expensive and the free money math no longer works. This triggers a process called repatriation, where massive amounts of capital start flowing out of foreign assets and back home to Japan. This is a critical threat because Japan has been one of the most consistent buyers of U.S. debt for decades. If this giant exit occurs, U.S. bond yields must rise to attract new buyers. As legendary investor Ray Dalio points out, the bond market is the backbone of all financial markets. While we obsess over the Federal Reserve's short-term rate cuts, the Fed doesn't actually control long-term rates. Supply and demand do. With the U.S. running trillion-dollar deficits and needing to issue massive amounts of new debt, the loss of a major buyer like Japan is devastating. This is why mortgage rates can stay high and stock valuations can get squeezed even if the Fed tries to ease conditions. Mainstream media largely ignores this because yen carry trade isn't as clickable as Nvidia or AI. But the reality is that liquidity is the oxygen of the markets, and that oxygen is getting thin. The biggest risks are rarely the ones making the loudest noise. They're the ones hiding in plain sight, quietly shifting the foundations of the global economy. Understanding these invisible shifts is more crucial now than ever. The danger of the unwinding isn't just about numbers on a screen, it's about a global domino effect. For decades, the world operated on the assumption of infinite cheap liquidity. Now, as Japan closes its ATM, we're entering an era of high-cost capital. When the world's largest creditor starts calling its money back home, every over-leveraged sector, from high-growth tech startups to commercial real estate, feels the squeeze. We are no longer playing the same game. The rules of the last 30 years have been rewritten overnight, and those who fail to see the shift in Tokyo will find themselves underwater in New York. The tide is going out, and for the first time in a generation, we're about to see who's been swimming naked. As we navigate this transition, remember that the most significant market moves often happen in the shadows, far from the glare of breaking news headlines. The yen carry trade is the tectonic plate shifting beneath the surface of the global economy. If you want to protect your portfolio, stop watching the noise and start watching the math.
If you found this deep dive valuable, hit the subscribe button and join us as we continue to track the invisible forces shaping our financial future. Thanks for watching, and we'll see you in the next one.